Good morning, everybody. It's Tuesday, November 19th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Quickly here, overnight markets had December corn up a quarter, 429.5. January soybeans were down 5.5 at 1004.25, and December Chicago wheat was up 4 3/4 at 552. Yesterday afternoon, we got crop conditions. Winter wheat came back better than last week, 49% in the good to excellent category. That's up from 44% the previous week and 44% for the average. And that crop is 94% planted. That's up 3% from last week. Good morning, guys. I think the major news headlines here this morning really are just escalating tensions in Russia. Got the outside markets kind of whipsawing around. The stocks were down 500 here just a little bit ago. So, Ben, maybe a few thoughts to start us off this morning, and then we'll kick it around the room.
Yeah, geopolitical headlines are always a difficult trade. Just kind of reviewing, I've had some outside conversations with people in the industry talking about what something like this would mean if it were a worst case scenario with nuclear type stuff. And I think it's really a difficult place to connect the dots. If you historically look, Chernobyl was an example where we were limited up for a few days, and Fukushima, we were limit down. I don't think we're headed to those types of events. I certainly hope that we're not. Disappointed that we're escalating it at this point. And that seemed to catch people's interest yesterday. We saw energies have a really pretty nice rally all day long. I think that shook some shorts out of soybeans. Not really seeing much follow through this morning. I look more at, kind of where we're sitting this morning with well over 400,000 contracts still open in the December contract, with about 7 days till they have to start really thinking hard about being out 8 days. So I think that kind of they're staring down the barrel on that. We haven't seen a lot of aggressive corn sales for a few days now after having a really nice run there. So, markets, a lot of options left to expire. I still think that the grower is largely undersold, wondering if they get rewarded for being patient. It is worth noting that in the East, we've seen basis pop a little bit, and very close to 450 cash corn is being rewarded by quite a few growers. So, maybe that's what we need to do to kind of fill in this void here as people are trying to get their needs met throughout the last half of this quarter. So everything to me looks okay in South America at this point. They did take the drier areas of Brazil a little bit drier. It's always worth watching last Friday weather maps, but beans have been reluctant to respond in any meaningful way. So, maybe just a really kind of a wider sideways chop in both products here until we get to the January report. But you think that's going to be the case, and you see headlines like yesterday, uncertainty over a new administration, and volatility that's very, very cheap. So I'd be very cautious on how you go about constructing hedges with those variables.
Yeah, to that point too, right? The announcement out yesterday that Brazil announced an agreement with China on Wednesday. What was the quote? I think the Brazilian ag minister said, "Trump clashes with China, Brazil will seize the opportunity." I'm guessing they're trying to get ahead, not get caught off guard the way they did last go around.
Yeah, but so what? I mean, they've already been buying everything from Brazil. So I mean, Trump's kind of the wild card, right? It's they don't need Brazil's economy; they need U.S. economy. So, I guess my point to that would be, they've been buying all these resources from Brazil. At the end of the day, they need U.S. money to keep their economy, which is struggling, going. So it's going to be more important to me what the Trump administration does with China versus what China and Brazil do, right?
Yeah, but I mean, if he goes and forces the completion of phase 1, right? Stuff to that effect, they got to come buy from us anyway, right?
Yeah, just Brazil's not supporting China's economy. The U.S. is. So U.S. has the bargaining chips there. I mean, they can go do whatever deal they want, and China will be like, okay, yeah, never mind.
All right. Seen that before.
I changed my mind. I guess that's my take on it.
Yeah. Well, hopefully they stop. We stop importing Chinese cooking oil. Would be nice. Support our bean market that way somewhat.
Yeah, no doubt.
One thing I'll note, because this is option expiration week, we have 100,000 in the money call options right now, and 62,000 in the money. I'm sorry, 100,000 in the money put options and 62,000 in the money. Sorry, it's the other way around. 100,000 in the money call options, average price 412. Interestingly, and 62,000 in the money put options, average price 451. So gravitation in between those two, maybe somewhere right around where we are, mid 420s, could be where we end up. But if retail is holding that position, and we start to see people exit that prior to Friday, it would be a little bit more negative going into the end of the week.
Yeah, it's going to be interesting after this options expiration going into the end of the year. I still think between now and mid-January, there's a lot of reckoning that has to happen with, farmers going in for, loan renewals and having those discussions with their banker, realizing that we had these big yields. It's people aren't happy with the price, but it adjusted based on these big yields that we've had also. And good cash. And we've had, 30 over basis in St. Louis, 40 over basis. So we've had really good cash prices relative to yields to offset, a large part of this price decline. So the worst case scenario is that we give up the price, and have to sell it. I'm curious what between now and like I said, sometime mid-January, what's going to happen there, especially if South America keeps looking decent. I don't know.
Yeah, strong basis, strong spreads. Obviously, not enough grain flow right now. Funds are getting long. Generally they're getting long the front end of the market. That might be why we're seeing stronger spreads as well too. But like the fact that the backdrop is not weakening basis is just a tell sign that, if anything were to happen in the currency, in my opinion, if the dollar were to start to fall again, that would be very supportive for flat price at the moment, just because of all the signs we're getting.
Mm-hmm. Yeah, and I'm not overly bearish corn by any means. I think maybe it's just like where all the money. If you look at, we talked about this yesterday, but there's 2.1 million contracts of open interest in corn, and 1.95 is in old crop. So you think about it's over 90% is So when you go from short 400,000 contracts to long 100,000, that's all in the front end, which has been a windfall, I think, for producers with big crops, especially. You've had good basis. Carries have gone down to zero or inverted in some cases. So if you have a lot of grain and you have low volatility, you should be really moving as many bushels as you can at these levels and buying options out forward. There's just not a big incentive, in my opinion, to just be holding physical grain with the kind of incentives that the market's giving you right now.
Right.
And that has nothing to do with opinion on flat price, just how you use your money. You should be offloading it on the market with these good basis levels and tight spreads, and re-owning cheap volatility out for it if you think there's a opportunity.
Oh yeah. I would say that, like, let's say that you can make the argument in the years like 2012, for example, there was a huge inversion for beans. At one point, November was $2 over the July contract. And, the market was asking for more bushels to be committed for, that November through January timeframe. Well, anyone that didn't do that, they held beans in the bin. They would have still have reaped a good reward holding that to the spring, because the futures did rally. And so the argument for a lot of growers might be, well, if it's tight now, it's only going to be much tighter later. In this case, when you're looking at that corn balance sheet, there's a lot of things that have to happen for it to get super tight in the end. So to your point, like if there's just not enough flow and they're trying to give you a premium to incentivize that flow today, you can still remain long. If that's the entire goal of what's, in the bin, is that you want a higher price in the end, you can remain long on paper in various ways, right? In some cases, with a lot more definition to the risk, with some sort of option, where you have a floor through the cash sale nearby, and then the length out through, like let's say a July 25 timeframe, and come out ahead in a few ways. If we start to rise and we have a near 2 billion bushel carryout projected, I would imagine there's a lot of bushels that are in bags right now and in bins that want to move. And if the market does start to rise, that could start to hit spreads, could start to hit basis. And you already have that, that nearby contract locked up, good basis, and your length is, in the back end where the market's being most supported. That would be the best outcome, obviously, if you made those changes now. So,
yeah.
And I'm not saying that that's exactly how the script is going to go. It could go the other way, like it did in 21, where March and May did a lot better than July did. It could go either way, but right now I'd say we've got a pretty good chance for a near 2 billion bushel carryout, and there's just not enough bushels moving at the moment.
Yeah, and like it's just position management, right? I mean, to your point, in 2012, there's a lot of people that gave up a lot of money by not understanding to sell a $2 inverse and re-own it where it would actually be tighter. So there's always going to be more bushels December 1st than there's going to be July 1st every year. And now you have a high interest rate environment. So when you get these kind of opportunities, it's just about being smart about money management, position management. There's no scenario where there's not going to be less bushels in July than there is in December. So the fact that, we're in this position where, whether people are holding on or they had to sell too many old crop bushels, going into September 1st, which is kind of my theory. So now they're just kind of holding, but there's a lot. Sometimes there's a herd mentality in ag where everyone's holding, it gets tight, and then everyone decides they need to loosen up and free up some cash, between now and first part of the year when they're having these discussions and figuring out everything. But you should take advantage when people, are being stubborn. You should be aggressive, and vice versa. I mean, it's no matter what the market conditions are, it's just being smart about where you place your chips or where you want to use that money.
Yeah, I think you hit it on the head in saying, how do you want to basically deploy your assets and handle your risk? And in the Eastern Corn Belt, they're essentially $1 higher cash price than they were at their worst place in harvest. And you can pick the amount of money that you want to own or spend or call spreads in whatever time frame, get a lot of coverage, and retain 80% of that dollar. And that is, that's just the true math of where it's at. It doesn't mean it's going to be perfect or work out for you, but you're taking advantage of that gift that's materialized over the last 3 weeks.
Yeah, and it's one thing that I think we've noticed over the many years is a lot of people take on unnecessary risk. So there's always risk in farming, marketing, all those things, but do it smartly. Like you don't have to risk all your money all the time to be bullish or bearish. There's just, like I said, money management I think is really important, especially in these scenarios where, the margins are tight or negative. You just have to be really on top of it, I think, in the next year or so.
All right. Good stuff.
End of rant. End of rant. Yep. End of my rant.
Oh, that's good. Drop the pen. All right. We'll move over to livestock real quick here, Ryland. Good start to the week for cattle. Pretty light volume in the hogs. So what are your thoughts today?
Yeah, not too much news coming out of yesterday. I mean, I think just overall, everybody's been kind of just kind of watching cash cut out, that kind of stuff. No cash yet, of course, just because it's early in the week on the cattle side. But I mean, the breakout in feeders has been pretty impressive. I think that's really the talk of the town. It seems like cash markets pretty much all over are staying really strong. Pasture conditions are getting a lot better just because of the moisture that's come to those regions. And we may be seeing a little bit of concerns about potential tariffs on Mexican feeder imports. So, I mean, I think all those things have kind of culminated, and we know managed money's long. So it feels like they're starting to compress a little bit with the market kind of doing what it's doing. So overall, the feeder story is still on the friendly side of the market right now, and I don't think anybody's going to dispute that. So we'll see how high they want to push them today. We do have the report coming into Friday, cattle on feed report, so that's going to be something that may kind of stall this out as we get into kind of the tail end of the week. But overall, it just seems like that's really where a lot of the focus is going to go. So keeping an eye on that for now. In the hog market, really not much new to chew on. I think everybody's waiting to see if cash market cutout is going to fall back now that we've kind of made the move. We've kind of priced in this kind of front-loaded demand. So we'll see how this kind of shakes up. Bellies were down just a little bit. Cash hogs were down $1.35. So we're not seeing those big jumps that we kind of saw over the past couple of weeks. So things seem like things are moderating a little bit, which may just be kind of, overall, I think we probably get some producer hedging if we just kind of sit around here. So overall, just kind of watching, waiting, seeing what changes here. Don't expect anything crazy just yet, but I think a lot of the focus is going to be kind of on the outside markets, on a lot of the outside headline news and whatnot going on in Russia and Ukraine. So it's going to be a lot of kind of macro, I think, movement in the livestock today.
All right, appreciate the update. We just came into the open. We got December corn unchanged at 429 1/4. January beans are down 5.5 now at 1004 1/4, and December Chicago wheat's up 5 at 552 1/4. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like or subscribe. It'll keep you up to speed on everything AgYield. So once again, thanks to everybody that supports the show on a daily basis. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments there, guys. It was a good show. Hope everybody has a good day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.